People often say that a house is the best investment that you can make, and this is certainly true for many of us. The typical Kiwi dream often involves starting a family, purchasing your own property, and maybe getting a dog or cat, or maybe both. For the majority of us, this means going through all the different banks to find a good mortgage rate. But it's not just about finding a good rate. There are many different types of mortgages out there. In this video, I'll be doing a quick overview of the different types of mortgages that are available in New Zealand and some advantage and disadvantage of each. Now, this video is not meant to be financial advice, but it'll give you some understanding before you go talk to your bank or a mortgage broker to negotiate for your loan, so you have a more clear idea of what to expect. First of all, we'll be going over what fixed and floating interests are. Secondly, we'll be looking at different types of mortgages, including the traditional table loan, the offset loan, the revolving credit loan, the reducing loan, and the interest-only loan. Before getting into the different mortgages out there, let's look at a common question. Is your house an asset or a liability? In its purest definition, an asset is something that brings in money, and a liability is something that takes money away from you. So unless you own rental properties, where the rental income is greater than the mortgage plus insurance and other fees, your house is taking money away from you because you are paying rates and insurance and mortgages. And this is true for the majority of family homeowners. But some people might say that you can sell the house at a higher price for capital gains. While that might be true, there's no guarantee that when you sell the house, you can definitely sell it for more. Natural disasters such as earthquakes may occur and crash the housing market before you're ready to sell. There is a clear difference between investing for cash flow and investing for capital gains. And you can learn more about it in this other video, which I will link to in the card above. There are two types of interest rate. There's the fixed interest and the floating interest. The interest rates are closely related to the official cash rate. When the official cash rate decreases, so does the interest rate. And you can find out more information in this video here. With a fixed interest loan, you can fix your interest rate for 6 months to 5 years. And later on, you can renegotiate your loan at the end of your term. So some of the advantages for that is that banks often offer special rates to try attract new customers. And you know how much you are paying each time. And you're paying less if the interest rate goes up in the future. And a fixed loan generally has lower interest rate compared to the floating loans. Cons of this includes it is less flexible when it comes to changing contract and early repayments. And there is often a break fee if you decide to change anything. And you be paying more if the interest rates go down in the future. Floating interest rate is heavily related to the official cash rate, and the change in rates can affect the amount that you pay for each repayment. So the pros of this is that you can make changes to your loan terms more easily and make early repayments. So by making many early repayments, you could potentially pay less on interest over the long term. And some of the cons for this is that the floating rate is usually higher than the fixed interest rate. Quite often people use a combination of fixed and floating interest. Again, check with your bank and or your mortgage broker for more information on that. Let's now look at the different payment structures. First off is the traditional table loan. Now, this is the most common type of loan, with regular repayments weekly, fortnightly, or monthly. Repayments pay off both the interest and principal, with early repayments mainly paying off the interest and later repayments mainly paying off the principal. Most lenders let you select a loan term of up to 30 years, and you can have fixed or floating interest rate with a table loan or some combination of both. Some of the pros of this is that regular repayments provide a sense of stability to make sure that you are constantly working towards paying off your loan. And the cons of this is that payments can be difficult if you don't have a steady source of income. Next up, we have the revolving credit loan. So the revolving credit loan works like a giant overdraft. It's a transactional account with a floating interest rate where your wages and bills go in and out of the same account. Interest is calculated daily, so it pays to keep your loan balance as low as possible. You can withdraw funds up to a pre-approved credit limit. And a good trick is to use credit cards for paying off general expenses to keep your revolving balance low and pay off the credit card amount in full each month. Minimizing the use of cash and FPOS can also help to keep your balance low. There is no regular repayment schedule, so it suits people that are organized financially and want to pay off their mortgage as soon as possible, or self-employed people with irregular income. The main pro of this is that there's no fixed repayment amount, and you can make bigger repayments if you can afford the money to do that. You can also take out your early repayments as credit again at a later date. For the cons of this, it requires more discipline from the borrower to make sure that you are not constantly withdrawing to the credit limit so you can actually pay off your loan. An offset loan is another floating account that aims to help you save on interest by linking your everyday and savings account to your mortgage. However, they are still kept in separate accounts for easy management. Interest is calculated every day, much like the revolving credit loan. You only pay interest on the offset balance. For example, if you have $300,000 in mortgage and have $20,000 in savings and $5,000 in your everyday account, you are only paying interest on $275,000 mortgage. The pros of this include you can pay off your mortgage faster since you need to pay less in interest due to the offset. Some lenders can link your parents' or children's account to help you offset your mortgage. If you have enough money between all of the offset accounts, you can completely offset the loan so you don't have to pay any interest at all. Some of the cons of this include your savings account don't actually earn interest, but usually this is fine since the interest on the loan is usually higher than a savings account. A reducing loan is similar to a table loan in that you make repayments at regular intervals. However, your repayments start off higher and your principal repayments remain the same, while your interest repayments reduce over time as your loan gets paid off. The main pros of this is that you are paying less interest over the length of the loan compared to a normal table loan. It might be a good option if you expect your income to decrease, or if you or your partner plan to stop working for a period of time. And the main cons for this include repayment is higher in the short to medium term, and if you have the financial capability, it might be better to just use a table loan with a higher repayment so that you can pay off your loan even faster. Next up, we have the interest-only loan. So you're only paying the interest part of the loan and not the principal. It is possible to use an interest-only loan for 1 or 2 years and then switch to a table loan. Interest-only loans are often used for property investments to free up cash for other purposes. The main advantage of this type of loan is that the repayments are lower, so you can free up cash for other purposes such as housing renovations. And the main con for this is that you are ultimately paying off more interest over the long term, because you are only paying off the interest in the beginning and not the principal. For more information on the various different types of loans, including some handy home loan calculators, be sure to visit the sorted.org.nz website. Next time we'll be looking at some numbers to see whether buying a home is always better than renting, and whether you can still make money if you only decide to rent. So stay tuned for that, and I will see you in the next video.